Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone, and welcome to the Millionaire Next Door podcast. I'm your host, Robert Curtis. Thank you so much for listening. Market volatility, political uncertainty, competitive forces, and various external dependencies, they're all facts of life for a professional and a team such as mine. It would be great if the world cooperated with our plans on a consistent basis, but that's not the way it always is. And that's why clients engage us and our team and our process. So I wanted to go a little further into that, into the process and some of the things we're seeing and ways we're assisting clients. And to do that, I've brought along Sam Miller. He's a repeat guest. He's the Director of Research at our firm, Signature Estate and Investment Advisors, SEIA. We've had him on. He's shed a lot of light on some of the processes that we're deploying for clients that they may not fully be aware of, but I wanted you to get a sense sort of under the hood, some of these things that we're seeing. And today we're going to delve into the world of alternative investments. So let me welcome Sam. And Sam, I'll let you just kind of kick it off and talk about what alternative investments are, how we're integrating that with clients, and we'll go from there.
Absolutely. Great to be back, Rob. Hope all is well on your end. So we can kind of start at the top, and the word alternative investments, it means different things to different people, but what do we do in 2023 when we have an important question and we want a really scientific answer? Well, oftentimes we go to Twitter, and there was someone who I follow who actually posed a question to their followers on their timeline. When you hear the term alternative investment, what's the first thing you think of? And of course, you're getting the range of responses from things like complexity, fees, misunderstood, opaque, illiquid, unnecessary, diversification, scam. These are it's a polarizing topic, and the question is why is that? So I think the alternative investment industry is associated with some of the brightest minds in the world, some of the best investment managers out there, but also there have been some pretty high profile blowups and scandals. There was a show, I believe it's on Showtime, called Billions. And it's loosely or not so loosely based on a company called SEIA Capital, which was one of the most successful hedge funds in the world. They averaged 30% returns every year, net of fees, for over 2 decades. That's unheard of. But they also pled guilty to insider trading about a little over a decade ago. So they were maybe breaking some rules in the process. They ended up paying billions of dollars in fines, and they don't exist anymore. But they're the subject of these sorts of high-profile shows on HBO, Showtime, you name it. And there's all sorts of stories like that. So that's why you get such polarizing responses when you pose questions like that on Twitter. But ultimately, at the outset, Rob, you talked about helping out our clients and your clients from a planning perspective. So at the end of the day, yes, it's a polarizing topic, but let's cut through all of that. We believe that as investors, we're trying to help our clients get from point A to point B. If we can build a sounder portfolio that maybe includes some of these alternative strategies, then they're going to be better off. And as a fiduciary, we have an obligation to at least explore that and educate our clients on the pros and the cons and the why of this space. And in certain cases, maybe it doesn't make sense, but in many cases, it does make sense for our clients, and it results in a sounder portfolio and a better likelihood of the client getting from point A to point B with their financial plan.
Wow, I don't spend time on Twitter, so I guess I was, and I didn't expect it to open and take that direction. But so it's interesting how the quote the masses are viewing it, or folks that comment on Twitter. I do, though. I've seen think of Bernie Madoff, right? And he got these incredible returns, kind of like the one you just referenced, that didn't reconcile with what other people were doing, and look how that turned out. Or these references I'll get occasionally from clients who I have some stuff in hedge funds, and I'm like, what is that? What does that mean? Are they really hedging? What are they doing? Are they charging 2%, 20% on top? So I've had a lot of trepidation about that space, but you guys are a formal research department with full fiduciary obligations. So you look into this, and what we're seeing, and I'll turn it back to you, is that once you ferret through that, and we'll mostly come up with the ones that don't deserve a place in clients' portfolios. But this had been the purview of really high net worth institutional investors, et cetera. And we're seeing it filter down more to the retail clients. And some of these offer some good diversification and sort of a safer bridge as we move through an interesting period in time with massive expansion of the monetary supply and the money supply, and rises in interest rates, and several bank failures, et cetera. So let me turn it back to you. But yeah, I hadn't expected it to go in that direction, but that's what's out there. People are hearing. So talk a little bit more about how we're viewing it, the work you're doing, what are some of the benefits, how it's being used, all that. Go ahead.
Yeah, I like to keep you on your toes, Rob. So I'll try to throw more curveballs. Let me pose a question to you. How many mutual funds are out there in the universe today? Any?
Yeah, a lot. I don't know, probably 10,000, but
you're pretty close. It's a little under 10,000. It's been about around a little north, give or take 8,000 for the past 2 decades. So if there's 8,000 mutual funds out there, the next question is, how many private funds do you think are out there? More than 8,000 or less?
That is a good question. I would think less.
So you would think less because you probably don't come across them every day. But the fact is there's over 40,000 private funds out there today, over 18,000 private equity funds, over 9,000 hedge funds. And the fact of the matter is there's a lack of regulation around these. So when you don't have to get things approved by the SEC or follow all the rules that a mutual fund would do, a lot of people opt for going the easy route. So the point is there's a lot of vehicles out there. And you're right, to your previous comment, this was historically lived in the space of the institutional world, endowments, foundations. More and more, these vehicles are becoming available to people in the ultra high net worth space, and the high net worth space, and even in the mass affluent space. People with smaller account sizes can get access to these vehicles. So my point in telling you there's 5 times as many private vehicles out there is you've got to really have a robust process to get it down from 42,000 vehicles to something more manageable. So for us, we have a short list of, call it 15 to 20 that we feel good about it. So how do you get from 42,000 plus down to 15 that you feel good about, that you might be comfortable working with your clients and using in a portfolio? So there's a process that we use, and it's a top-down process. So we start at the highest level, which is what's our macroeconomic outlook, and that's developed by our investment committee. So how do we view the world? What sorts of strategies may or may not work in this sort of market environment we're in right now, where we may or may not be heading for a recession, but we definitely think we're late cycle either way. We've got interest rates where they are. We've got inflation concerns. We've got geopolitical concerns. We've got a debt ceiling. So that's what needs to shape this narrative. That's the top-down macroeconomic outlook. So everything needs to fall in line with that. Next part of the process is the investment thesis. So what sorts of ideas in the alternative landscape would align with that macroeconomic assessment and which sorts of vehicles would fall in line with specific client portfolio needs. So that's the next layer, is the investment thesis. The third level is a pre-screen, which is basically our way of getting that list of 42,000 vehicles down to something much more manageable by just eliminating the worst of the worst. So we have specific guardrails that we put in place. We're not going to work with any asset manager or private vehicle that doesn't have at least a 5-year operating history. Many of them don't. We're not going to work with the smallest firms. We have a specific AUM or asset threshold. You got to be proven. You got to have been doing this for some amount of time. You got to have a certain amount of assets in this sort of strategy that we're looking at. And then it's also got to work with us from an operational perspective. You got to have your assets custodied at Schwab and Fidelity. And that was the issue with Bernie Madoff that you mentioned earlier. One of the issues is he was handling all the custody himself, which meant he could fudge the numbers. And when we have a third-party relationship with a Schwab or Fidelity, we never physically take custody of client assets. They still own their assets. They're held at a third-party provider like Schwab or Fidelity. So those simple pre-screens help us get that list down from 42,000 to something much more manageable. So then we have our team on our side that works with other third-party providers from a research perspective to go into and do the kicking of the tires and the due diligence. And we really look at 4 key tenets of the due diligence process. Once we get down to that short list, we look at the strategy and the investment process. So that includes, how do they come up with ideas? What's their track record? What's the scalability of their opportunity set? What's their competitive advantage relative to other people that are running similar strategies? The second piece is risk management. So do they have a risk committee? Do they have specific limits around how much risk they can take, how much leverage they can put on the portfolio? The third piece is the management and the analysis of the team. What's their background? Do they have sufficient experience? Is there alignment of interest in terms of compensation and things like that? And then the last piece is the operational due diligence. So looking at their policies and procedures, doing background checks, all of those things go into the operational piece. So after all that is said and done, we finally get comfortable with this vehicle, and we'll bring it to the table and potentially start using it in client accounts. And this could take the quickest we've ever gotten comfortable is maybe 6 months. In other cases, it's taken years, but a lot of work goes into making sure these are, one, right for our advisors to use with their clients, and then ultimately, making sure a client is comfortable and understands the pros and cons and benefits and drawbacks of such a solution. So hopefully that gives a sense of, like, at a high level, what goes into the process for bringing these to the table.
Yeah, I think it does, and I can elaborate a little bit. Process is just so important, and that's what I wanted to highlight. You might be spending 6 months to 2 years, a whole team of trained investment analysts really looking through, 40,000 roughly gets reduced down to 15. I mean, that's pretty elite. We're doing a lot of diligence. And a lot of reasons these are used by high net worth or institutions, as you'll probably allude to, they have sophisticated research teams, or they're supposed to be sophisticated on that level to where they can do this. Most folks don't have the diligence. So unfortunately, a lot of folks just read something in a publication or on Twitter that doesn't have the background. It's coming, I hate to knock them, but from a journalist who doesn't understand, doesn't have your kind of training, doesn't do the discipline and the research to really understand what we're dealing with it. So you've really come up with very differentiated processes that are sound. I think a lot about sports. So there's this, in March, the March Madness and the college basketball tournament, and there's 64 teams, and you get down to something called the Sweet 16 and then the Elite 8. These are really top teams in the country. And there's probably thousands of college basketball teams, but these are the best of the best. And this is what we offer. And we do that diligence, and we do that work, or you do that work, I should say, for clients. And we're very engaged and utilize that process and view you as very much of a part of our team. But there's reasons why someone might want to put these into a portfolio. in addition to mutual funds or ETFs or things that are publicly traded. So I think that helps a lot. It's and this even gave me a different perspective, a really elite 15 out of tens of thousands of funds out there that probably merit some consideration or discussion. So thanks for that. And I'll let you continue on a little bit.
Sure. So like we talk about kind of the process of getting to that short list, but hopefully I've elaborated on how much effort and energy goes into it. So some people might be asking, well, is it even worth it? Do you need to go down this rabbit hole and spend hours and hours of your time? And our belief is that, yeah, I mean, if we can improve the likelihood of a client's achieving their goals by building a sounder portfolio, then we have the obligation of at least exploring that. And I think you were just alluding to the why. To me, it's about expanding your opportunity set. Yes, in many cases, you can get from point A to point B in terms of your financial plan by using a portfolio of ETFs or mutual funds or individual stocks and bonds, and you don't need to go into the realm of alternatives. In other cases, it does make sense. I think if you think about your opportunity set being U.S. stocks or even global stocks, most companies in the U.S. are not traded publicly. They're not the household names that we've come to know, and Microsofts and the McDonald's and Coke and Pepsi, the tickers that everyone knows. Most companies in the United States are actually private businesses that never have to go to list their shares on a public exchange. So to tap into that realm, you've got to go into this world of private investments. And my belief is that by expanding your opportunity set to include lots of these great businesses that just have never needed to go and go public, you can again expand your opportunity set and have a better chance of success in your portfolio. So that's one why. Another why is diversification. So for us, there's many people who are okay with riding the highs and the lows of the stock market, and they can sleep just fine at night when the market is down 20, 30+%. I would say that's not most people. That's some people. Most people get a little bit nervous. They maybe have issues from a behavior perspective. Maybe they want to sell at the wrong time and buy at the highs and sell at the lows. And it's just this thing that's related to our human nature. If you can add diversification to your portfolio, when stocks are going up, there's maybe another piece in your portfolio that's acting differently and vice versa. That helps to smooth out the ride. And that's the diversification benefit of many alternative strategies, is that you don't want everything in your portfolio doing the same thing at the exact same time. And over the course of time, these asset classes are going to offset each other and provide value from a diversification perspective. And then there's other whys with alternatives. Another piece might be for many people that are in retirement or getting close to retirement or just have some sort of an income need. I think, again, by expanding your opportunity set, there are certain asset classes within the private markets that can generate a higher degree of income than you could get from a treasury bond or even a corporate bond, even though treasury bonds are around 5% these days. So it's not a bad thing, but you can do better than that in the private world. So again, back to the original thought, it's expanding your opportunity set gives you a better chance of success over the long term.
Yeah, no, that's great. I mean, and it's also, when you think of this elite 15, we're really concerned with having sort of excellent players in your space if they're going to fit in a portfolio. I mean, even if you look at the S&P 500, I don't know that I want to own all 500 of those stocks. Really, there's probably, 25 or 30 of those businesses I really want to own. But that you can look at things. I think of like In-N-Out Burgers, the classic. You cannot really invest in that. But anyone, certainly in the western part of the U.S., knows that's incredibly profitable. Or Trader Joe's, you can't really go into. But those are, some of these offer the ability to get into there or into legal finances, maybe where they're financing a law firm, et cetera, or royalties, things like that normally you wouldn't get at. So those are streams. And what kinds of incomes are you seeing, and what kinds of volatility relative to, say, public stock or bond markets. Is there a way to give some thoughts on that?
Sure. So there is still the traditional risk and return spectrum. So in order to get more return or more income, you typically have to take more risk. But we've seen certain private asset classes that are yielding in the double digits. So 10% plus, and that again, that depends on the types of risk that are being taken. But you're not going to see that very often in the traditional public space.
Yeah, yeah. And, to clip that kind of a yield in this environment, when we may be looking at the onset of a recession or at a cycle top, like you said, that's pretty compelling. Talk a little bit about, I guess, typically in a portfolio. I think we are looking at maybe 10 to 20% allocations, endowments, universities, high net worth. They might be looking at different percentages. Give us a little context. What percentage of a portfolio is typically viewed as sort of the right amount, kind of like a diet, right? You want to have a certain amount. Just because it's good for you, it doesn't mean always that more is better. But there's probably a certain amount that's probably good for your overall portfolio or diet. Just some thoughts on that would be helpful.
And I think the benefit of working with an advisor is really dialing in that number to something that works for the client. And maybe it's 0, maybe it's 5, maybe it's 10, 15, 20. That's the beauty of working with a professional like you, is you're going to understand what their time horizon is, what their liquidity needs are, what's important to them, what type of returns do they need to see out of the portfolio to achieve their goals, what sort of risk are they comfortable with, and then you can dial it in from there. But I think two of the primary levers when it comes to alternatives are the time horizon and the liquidity requirements. So if you think about those endowments that you mentioned, Yale, Harvard, whomever, they think in generational terms. They're willing to think over the course of hundreds of years, literally, in terms of their investments. So they can afford to have a really long time horizon and be very patient with their investments. So what we see in the private client space is some people are able to think about generational wealth, but other people have to think about funding their retirement next year or paying off a loan or something like that. So again, that goes back to the advisor working with the client to understand their liquidity needs, what's important to them. So, and that is ultimately going to drive what might end up in the portfolio and the percent of the overall portfolio. But, I don't like to speak in general terms, but 10% ish is a good number to think about in terms of carving out an alternative sleeve for a portfolio. Less than that, it's probably more hassle than it's worth. If you get closer to 20%, you maybe have some issues from a liquidity and from a fee perspective. But again, it's going to be highly dependent on the individual client situation.
Yeah, for sure. And I love that you reference that, because that's what I do is I work with these folks. Basically I let them know they're available and that they might be attractive to them and they should consider them. And then I'll look at percentages, what's normal, also what are their liquidity needs. And there are a lot of folks who are thinking intergenerational wealth, or maybe they're not thinking about it, but they should be thinking about it, because we're going to meet all their liquidity needs, but we're really looking to the second and third generation. Longevity is just a huge issue too, that I've been doing a lot of reading on and looking into. And, there are some folks might be living a lot longer. Centenarians, 110, 120, that sounds insane, but there's a lot of folks that are talking about that if we can structure it. So maybe they have to have portfolios that live through that. And we have a very custom discussion and what's right and what's appropriate, and just a couple of them to give you a little idea on, and you would know this well. There's one where the minimum initial investment is $10 million. but we can gain access because as a firm, we're well over that number, but we've done all that research and we can give people much smaller allocations, maybe in the $1,000, $10,000 range. There's another one we've been working with, and I'm told it pulls together different alternative strategies with a lot of diligence, but you'd literally need about $115 million on your own, which is out of most folks' reach that I know, to get into something like that. And you can do it very similarly, in $1,000, $10,000 increments, that kind of thing. So it kind of lets people have exposure to these things that were previously kind of off limits to them. Unfortunately, only the purview of the really high net worth and rich, but yet you have all the diligence through our research and through Sam and his team and my team of really looking into that. And that gives a huge window into the fact that there's really like 15 of these out of maybe 40,000. And so that should give you a lot of confidence. How many do you throw out and just say this does not meet this criteria, or we're not comfortable with this, or it's pretty good, but it's not really meritorious enough to be on the elite list of 15? I assume that's a common process, or how does that work?
Yeah, I mean, that investment pre-screen that I mentioned really eliminates the vast majority of the universe. You got to have that 5-year operating history, a certain level of AUM. We typically only look at firms that have north of $1 billion. That gives us a sense of confidence that they've had some success and know what they're doing. And of course, it's not a perfect screen, but it helps to narrow our focus so that we don't have to go out and kick the tires on hundreds. We're kicking the tires on dozens instead of hundreds and thousands. So it makes it manageable for us.
Well, I mean, this is great. That just highlights the process. We're a sounding board for clients. We bring this. We're using it a lot more, especially in this environment, than we had been. There's a lot of research and diligence behind that. That's what I wanted to emphasize here. We can have lots of discussions to see if it's right for you, but there's a lot of cash piling up on the sidelines. There's a lot of people in treasuries right now. There's a lot of people concerned about the stock market. So these offer some alternatives, and it's just a sounding board to have a discussion. But there's so much research behind it, and we're doing that. So I wanted to highlight that. And then we really go out and build custom portfolios for each client, which is a big part of differentiation versus a lot of our competitors who have sort of a cookie cutter pie chart asset allocation strategy of so much in each little bucket. But other times you may not want to be in those buckets. So we can go off grid like that. We don't have to just make it a standard one size fits all portfolio. It's a very customized thing. And that's another part of our process, getting to know clients, their liquidity needs, what's working, what's going to be right for their risk temperament, what's sort of best in class, on even a global scale. What is the best at what they do in a particular space and populating with that? So, Sam, it's awesome having you back to kind of give deeper dives into the process, and I hope that helps folks. Anything else? Any other kind of nice salient points or things you think folks should be aware of, or anything we didn't cover that should be shared?
Well, I think with your earlier comment about these vehicles becoming more and more available to individual investors, more so than they have been historically, what we are particularly careful about on that is, a strategy that may have been offered to an institution and now it's being available to an investment advisory firm or an end client. How has it been watered down in the process? Typically, if the terms change, maybe the strategy can't have as long of a time horizon, the fees change, like something has typically changed over the course of time. And it's not the case in every situation, but that's what we ultimately look for. Is it's not always a slam dunk just because a strategy becomes available to a different segment of the population. So that's part of our process, is looking at that. But I just wanted to circle on that because you had mentioned that a few times. Is yes, in many cases it's a win-win for the clients and for the institution who's running the money. But in many cases, what we're seeing is the strategies have been changed or altered in some way that's maybe not advantageous to the end client. So that's what we're particularly careful about.
Yeah, that's a really good point. So if you do hear of something like this, anybody who's listening, you're welcome to engage us. Ask us about it. We'll give you our candid thoughts. We've probably heard of it. We can look into it. Did something get watered down in the process of just making it available? Is it too good to be true? I know the things you're looking at, we're getting a big differentiator in this space is just getting fees really reasonable. And some of these large endowments can really negotiate on fees, and that's where they get their big advantage. And we have some opportunities to do that as well. But that's a huge point. So please bring these thoughts to us. We're doing the diligence. That's what we are as a sounding board. We've seen a lot of these things, and we can look into them. So we can give you that peace of mind, let you know if it seems sound, and put extra eyes and ears and really view and do the diligence on it. So that's a terrific point. So awesome, Sam. Really love having you on the podcast and giving a deeper dive, into our, we just want to familiarize people with some of the people in our practice, our process, how we go about this. This hopefully gives people a better sense of the real diligence going on before discussions happen and recommendations happen. And we'd be pleased to engage anyone in a discussion. So thanks, Sam. And I'll leave it there unless you, otherwise we'll sign out. But thanks for being on, and it's great to have you. Me. Yeah. Thank you so much.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Sam Miller is part of Robert's value-added support team, VAST, and contributes his expertise to portfolio and investment selection.